So the Fed has been a huge focus for us over the last 18 months to 2 years, especially as we pivoted from very, very easy policy to now, some of the most restrictive policy we've had in the last 20 plus years. And as we look forward, the Fed has just hiked interest rates to 22-year highs, 5.5%, and we think that broadly speaking, they're done. There's a possibility if the data cooperates, it doesn't cooperate with the Fed's view, we may see another hike, but really in the broad scheme of things, we don't really think it matters. Another 25 basis point hike is not going to really change, the overall picture. What really is important for us is we've, as investors, have come to grips with what to expect from Fed policy. It was very, very uncertain last year, and that was a big part of the negative price action we saw across equities and fixed income. And as we approach what we think is peak rates, it narrows the possibilities of what the future would look like. And so we think that's very healthy for market sentiment and for valuations. And so what we're looking at on a forward-looking basis around the Fed is really not so much what the Fed says, but what the economy does. And for that, and if you've been listening to anything that we've been putting out and writing, the U.S. consumer is really key and top of mind for us, and specifically the labor market. And so those are the things that we're watching most closely over the coming months, and not so much what Fed members have to say. So there are a lot of cross currents and interesting themes going on in the macro economy right now. I'll highlight just a couple here. One is that we're noticing that we've seen a rally in commodities over the last couple weeks. Crude oil is up almost 20% from its lows in June. And that's interesting to us. And you probably noticed as well, gas prices are on the rise. I think this is one of those cases where we've had a lot of disinflationary optimism in the market, and the narrative is definitely looking towards seeing some continued easing on the inflationary front. But some of the commodity and energy intensive prices are telling you something different. And so when narrative and price diverge in the market, that's interesting to us. And so that's one thing that we're paying attention to here in the US. Overseas, I think there are two really interesting stories that we're focusing on. The first one is in Japan. Japan has been a place that has been mired in malaise as they've recovered from their property and stock bubble in the late 80s. And what we've seen over the last couple months is a major pickup in activity in terms of the underlying economy, and also in terms of corporate, the corporate Japanese equity market. And so, putting those two things together and coupled with a potential pivot from the Bank of Japan to finally get out of negative interest rates, which has really weighed on sentiment for the region, we think that's an interesting macro theme that bears watching and is certainly informing our overweights to that region in some of our portfolios. And lastly, we've seen continued announcements of potential stimulus coming out of China. This is a trade that's really been a roller coaster for the last 9 or 12 months. And it's one of those things right now where I think the market really needs to see it. And so what we're watching for is, instead of just words, we're looking for concrete actions to get behind some revival in what has been a very, very slow and frustrating recovery from their COVID-0 policies. So we talked a lot about macro themes, and certainly it's easy to forget that we're over halfway through earnings season as we sit here today. And so we've been listening to company management, what they're talking about, how their business is performing, and what they see on a forward-looking basis. And a couple things that we're noticing, we've definitely seen a slowdown in earnings. Year-over-year growth rates in EPS for the S&P 500 are negative right now. And so that's something that is a little bit concerning as we think about the forward look in terms of margin pressure and cost pressure to try to rein that in. The other thing is the market has been, generally speaking, not rewarding companies that beat as much as they have been punishing companies that miss on earnings. And so this is something that we see typically when there's less fundamental support for underlying equities from the fundamental investing community. And so that's something that we're paying attention to. We certainly saw that in last quarter's earnings season as well. And so it's not a reason to fly the bear flag, but it is something, again, of price and narrative that are diverging a bit that has our attention. And the last thing that we're watching on the earnings front is that we're noticing some signs that the AI trade that's been so dominant this year is starting to exhibit a little bit of a loss in momentum. We're not seeing a reversal, but it is notable that some of the bigger names in the index have been getting punished for not showing as much growth on that front as maybe the almost 40% rally in the NASDAQ would indicate. And so this is something, we do think this is a really interesting long-term trend, but we have been noticing a little bit of a stall in this trade over the last couple weeks, and it's something that has our attention, especially considering how important we think this is for the coming months and years ahead.